Okay, great. Thank you very much. Welcome, everybody. The first question I ask is usually how many people have seen the basic candlestick presentation that I do. That way I know how fast to go. Okay, so, all right, looks like most everybody. All right. I see a couple people that haven't. So as I go through this, I'll try to refer back to the signals that we're using. But I've been using candlestick analysis now for probably, I can't even imagine, 30 some odd years. And as I've gone through, it boils down to one very simple explanation about candlesticks and the T-line. And the T-line is what we call the 8x or the 8 exponential moving average is what we call the T-line. And then we'll also have some reference to what we call the 3T line, which is the 3 exponential moving average. And for entry strategies and exit strategies, we can use those as in combination with our daily charts as well as our 10-minute and our 5-minute charts. So a lot of people ask, well, are those effective for daily trading? And the answer is yes, because the candlestick analysis boils down to that it's the accumulative knowledge of everybody buying and selling during a specific time frame. They work just as effectively on a 1-minute, 5-minute, 15-minute chart combination as they do on the daily, weekly, and monthly. I used to trade the E-minis off a 1-minute, 3-minute, 10-minute combination, and I do my swing trades based upon the daily charts, and then I use the 10-minute and 10-minute chart as my bellwether for when prices get out of whack. So on a chart like this could be a daily chart or this could be a 1-minute chart. They'll all look exactly the same. Oops, I guess that was the daily chart. And the 10-minute chart looks exactly the same. So depending on what time frames you're trading, the candlestick signals work just as effectively. So if the candlestick signals are the accumulative knowledge of everybody buying and selling during a specific time frame, which is basically the graphic depiction of what's going on in investor sentiment, it's very, I always go back to the very simple say explanation that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's all candlesticks do, is they show graphically what's going on in investor sentiment. Why not the simple moving average instead of the exponential? Doesn't matter. We've been very successful using the 8 exponential moving average. You can put whatever you want on a candlestick chart, because the nice thing about candlesticks is they work, or they wouldn't be around after 400 years. And the proof of the pudding was that the Japanese rice traders that developed candlestick analysis didn't become wealthy in Japan. They became legendarily wealthy. They were the powerhouse in Japan for centuries, and it was all based upon one simple aspect of investing, that human nature does not change. So the nice thing about candlestick analysis is if you can make the assumption that the signals and patterns work, now you can add or delete anything off your charts, testing to see if they work or not. Now that we have computers, exponential is just an easy figure. Yeah. So the exponential seems to work extremely well. So what is the T-line? Again, the T-line is that 8 exponential moving average, and the other moving averages on a chart, like we have the 200, the 50, and the 20. We have those on our charts because every major money manager around the world uses those candles or those moving averages to make their decisions as far as what's going on in their portfolio. The nice thing about candlesticks is we can see exactly what their decisions are at important technical levels. So they actually act as magnets that they bounce off these moving averages. But the T-line, the 8 exponential moving average, nobody uses that. So the one thing I tell people to do is put the T line on your chart and test it. And there's a very simple rule of the T line, and that is, if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. I don't know, is that me with going to sound going on and off? So, and conversely, if you see a candlestick sell signal and a close back below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. So this makes trend analysis very simple. A lot of people say, well, shoot, I don't want to be buying a stock that's already popped up 3, 5, 10, 15, 20, 80%. You do if you can see that the candlestick signals are keeping you up above the trend line or the T line, and you take profits when you see a candlestick sell signal and a close back below the T line. Even more compelling is you start taking profits or going short if you see a sell signal below a major moving average and below the T line. That's that much more compelling reason to be true or be short or long on a position. So candlestick signals have some very simple truisms, which are the further away you move from the T line. Now, again, part of that analysis was that you can stay long as you stay above the T line. You can be short as long as it stays below the T line, with a caveat. And the caveat is the further away you move from the T line, the higher the probability it's going to come back up and test it. So if you see candlestick buy signals well away from the T line, at least you know there's going to be a bounce back up to the T line, and then you've got some simple decisions. You see whether it goes through the T line and you're back in an uptrend, or if it fails here at the T line, you close out the position. And I've closed out tons of positions that I got into that failed, but I still came out with a small profit. The T line is just the 8 exponential moving average. The major moving averages are the 200-day simple moving average, the 50-day simple moving average, and there should be a gray line on here that is the 20-day simple moving average. So that, yeah, that's the 200 is the red, the 50 is the blue, and the 20 is the gray. Now, we won't go into this too much, but the 3T line, if you start moving way far away from the T line, the 3T line starts coming into effect, or being better for getting in or getting out of positions. So again, the further away you move from the T line, the higher the probability that if you see candlestick sell signals, they're probably going to come back and test the T line. So my philosophy is, why take the risk? Close out the position. If it comes back here in the T line and starts back up doing a J-hook pattern, you can always get back in. And this is part of the process of, I have told people for years that before candlesticks came along, I was the worst investor in the world. I did everything that a normal investor would do, which was all emotions. I would hate to take profits because, boy, what if this was the big one for my lifetime? This was going to make me rich. And I sold it here, and it turned right around and headed right back up. Well, now at least I can see graphically when to be out of a position and when to be back into a position, telling me the uptrend's still in progress. I have heard EMA and SMA both mentioned. The simple moving averages are on the major moving averages, the 200, the 50, and the 20. The exponential is the 8 exponential for the T line and the 3T line, which is the 3 exponential. Stochastics, my overbought and oversold conditions are stochastics above 80, overbought, below 20, stochastics of 12.33. And there was nothing more sophisticated in using those numbers than I would just go back to the charts and say, where's my bottom, where's my top, and what numbers fit the best. I'm a swing trader predominantly with my stock positions, which means my positions are going to be held 2 to 10 trading days. And then I'll trade commodities intraday, so I'll use the 5-minute and 10-minute chart to trade those. What's the green color? That's the 3 exponential moving average. I do day trade, but it's based upon how much profitability I've reached in one of my swing trades, or if I was trading soybeans or cotton or lean hogs and I had a big profit and knew that it was going to come back down to the T-line, yeah, I'll take my profits on a daily basis. So the T-line has some very important factors to it. This is what we call the T-line crunch or a bobble. Notice how when they did a buy signal to close above the T-line, they crunched through the 50, came up here, and where was it likely to fail? At the first resistance level, the 200-day moving average. This is where we take profits. But notice what it didn't do. They couldn't close back below the T-line. This is what we call the T-line crunch, where they couldn't close it below the T-line, and the T-line kept crunching right up into the 200-day moving average and taking it through. So if I was out in here someplace, I was back in here someplace. So a lot of people, and I say a lot of people because I had this problem myself, it would make me, I just kept thinking, I don't want to sell here and buy back here. Boy, would that be stupid if I bought back here and it turned right around again. Now I know, based upon the T-line and the signals, when to be out of a position, because at this point, we don't know whether it's going to reverse all the way back down to the 50 or below. But over the next few days, we can see they aren't selling it off. They're staying above the T-line and buying back here. If this is a 10-point move, and I can get 8 of those points, knowing that each time I was in that position, I was in the right direction, that compounding effect is much, much greater than trying to buy at the absolute bottom and sell at the absolute top. So here's that T-line crunch again, buy signals. This is what we call a left-right combo, a kind of a doji hammer, bullish engulfing. Came up, failed at the 50, but notice they couldn't close below the 50, and they crunched it up through, making the next target the 200. Took profits at the 200, but they couldn't close below the T-line. We're buying back when it comes back up through the 200. So it protects us by getting us out when it's time to get out and getting us right back in when it's time to get back in again. And again, this is not rocket science. This is basically using the same information that the Japanese rice traders have identified over the last 400 years to tell you what the high probability situations are based upon reoccurring investor sentiment. When your candles work with volatility, yes. Candlestick signals are the graphic depiction of everybody buying and selling whatever trading entity that you're looking at, whether you're trading Forex, bonds, stocks, commodities, tulip bulbs. Prices move based upon human emotions. So you can trade anything you want with it. Z, remember, the Japanese rice traders became legendarily wealthy on the most basic of all commodities, rice. So it works in all cases. Now here's how we use our analysis. We made lots of money not too long ago on VISN. There's our fry pan bottom. Looks like a big fry pan bottom. And where did it break out? At the beginning of the fry pan bottom. What kept us in this position? Notice all the way up here, they couldn't close this below the T-line, telling us our fry pan bottom breakout was in progress. But notice what was happening up here. The further away you move from the T-line, the higher the probability it's going to come back and test it. So instead of waiting to see whether it's time to be out here or time to be out here, waiting to see a sell signal, giving up some of that profits, when we see that we're in this type of situation where we're too far away from the T-line, we just flip to our 10-minute chart. Our 10-minute chart, here was the next day. We were getting right. This was the first day. Let me make sure I've got these right. This was that first day when we had big profits, which was right in here. The next day it opened up and started trading off a little bit. And where was it trading off? A good distance away from the T-line. But notice what it did after on the 10-minute chart. Came down, and then it came back up through. So we took profits right here and bought back right here. So the question is, why would you buy a stock that was extremely oversold or overbought way up here, because we know what the results of a fry pan bottom are. Huge, big price moves. So that gave us, the 10-minute chart gave us the impetus to go ahead and get back in, which we made this big profit move on that day. And then we closed out the next day when the price came off. So when we saw this type of action, we're taking profits. And then notice what we had. We had some buy signals, and it closed back up above the T-line on the 10-minute chart. We could hold it all the day long. And again, this was all based upon knowing what the results should be during that coming out of a fry pan bottom. So again, these signals work just as well on a daily chart, weekly chart, monthly chart as they do on a 1-minute, 5-minute, 10-minute chart. And this is where the 3T line also comes into effect. That if we start moving away from the T line, the 3T line becomes our next parameter. And if we're starting to move away from the 3T line, that's really giving us a warning that we're way up in the overbought condition. We want to get ready to take profits. So the nice thing about the T line is it allows us to do our trend analysis with much more clear refinement. That as long as we see a buy signal, we know when to take profits, and we know when to get back into the trend, as long as they can't close below the T line. This approach appears to apply to any time frame. Why do you avoid using it in a day trading environment? Oh, I don't. I don't avoid trading it. I just don't have time to day trade. I've got too many things going on every day. I do swing trade. When I was trading the E-minis, again, I was using the 1-minute, 3-minute, 10-minute chart combination. And made very good money with it, except I had to sit by the computer all day long and do it. Oh, what is considered a buy signal or a sell signal? RBOB, that's the basic. There's 12 major signals. There's 50 or 60 candlestick reversal signals. And when I first started doing candlestick analysis, I would ask people rhetorically on the financial chat rooms way back when they just started, back I think in the early 90s. I would ask the rhetorical question, why isn't everybody using candlesticks? They make so much sense and they work extremely well. And the answer was there was too many of them and they don't always work. And I always came back to a very simple assumption that if they didn't work, we wouldn't be looking at them 400 years later. And as I went through, out of the 50 or 60 signals, I wanted to learn every single one of them because I was greedy enough that I wanted to make money every time I saw a signal. But as I went through, I discovered there was only 12 major signals that you needed to learn, and it does two things for you. First of all, it puts you in situations where the probabilities are extremely strong. You're going to be in the right position at the right time. And on top of that, the Japanese rice traders even went further to tell you what the investor sentiment was that created those signals. So once you learn candlestick signals, you basically have the same background or knowledge of what's going on in a price trend as somebody that's been a seasoned trader for 50 years in the market. Yes, they work on Forex as long as you can figure out what time frame you want to trade. Obviously, there's no daily charts. Yes, and the Ichikumo cloud, yes, that's all part of the candlestick analysis. Is the bullish kicker the best one to buy on? Now, the bullish kicker is one of the strongest ones. A kicker signal tells you that investor sentiment has dramatically been kicked in the opposite direction. Oops. So anyways, this is why we can analyze when it's time to buy. And everybody's saying, well, when do you grab for the fallen knife? Well, the candlestick signals tell you exactly when that's going to occur. So what's our strongest signal? Seeing a signal, such as this morning star signal, which is a big down day, a doji, and then a third day closing more than halfway up this candle. And notice where it occurred. Right off a major support level, so we could see immediately they weren't going, that their buyers were stepping in at the 200-day moving average. It was also occurring when the stochastics were in the oversold area. This is what we call convergence analysis, where we can put as many elements of telling us that there's been a change of investor sentiment as possible. And then notice what this candle did. Closed well above this candle and above the T line, which makes it very simple. And I think I saw somebody's telling you what about entry and exit strategies. Very simple entry strategies and exit strategies with candlesticks. And it's all built on common sense. If you see a strong candlestick buy signal, what do you want to see the next day? You want to see the bulls are still there and they're confirming. You don't want to see it open back down here because that pretty much tells you that bulls aren't there. You don't want to be in that position right that day. So I'm buying on strength the next day because that's confirming everything that we can see on this chart. Or there's times where a price moves huge in the beginning part of the day, maybe in the first 10 minutes. And a lot of people say, well, I'm afraid of a gap and crap type situation. But we can see whether they're holding up, whether they stay right above the T line all day long, telling us that this, at the end of the day, this daily candle is going to be a big bullish candle. We can see what the announcements are. That this was kind of a Fed announcement a while back. Is the Dow going to stay up, or can we see on the 10-minute chart that it's backing off? Well, if we can see that they're continuing to take it up, that gives us that much more confidence to be buying positions. So we can do our analysis using trend channels or anything else that somebody else is watching, whether it's Fibonacci numbers, whether it's support and resistance levels, moving averages. If we can see where the trend channel is, and we can see where it bottoms with candlestick signals, bottoms at the same level with candlestick signals, and off a major moving average, what do we want to see up here? Well, we can analyze much more easily, visually, whether they're going to go through, and we can see that by, once they get up here, they are having a hard time getting back down through the T-line, and notice the T-line crunch pushes it up through this level, up into telling you that this is not acting as a resistance level anymore. So it helps you maintain positions when there isn't a reversal signal. Also, on a daily basis, if you're in an uptrend and you see days where they take it down, like this day, where they take it down, we can see on the 10-minute chart, they've taken it down. We're supposedly in an uptrend, but they've taken it down. Is this a big reversal day? Well, after a few 10-minute sessions, we can see whether they're bottoming here. And so this is just the early morning sell-off. It's time to be buying back into the market. And again, this is where the 3T, when you have a big price move away from the T-line and you start seeing sell signals, you don't want to see it close back below the 3T line because that tells you you're going to come back to the T-line. So you take your profits. You can always buy back, seeing whether the T-line is going to act as support or not. Yeah, and here's another one with that gap and crap type scenario. They gap it up. You can see that they've pulled it back a little bit. They haven't crunched it. And then you can see, even if you took profits up here, you know you could be buying back in whatever you were trading, whether it's the markets or an individual stock price, based upon it coming back up above the T-line and getting you back into that long position. So anytime I see a big price move, I'm using the T-line and the 3T line to tell me, all right, is it time now to take profits? I don't want to wait to see a sell signal up here because a big move like this, I'm giving up a lot of profits. That's where I can flip to my 10-minute chart and say, all right, if I know on an analytical basis that we're way up in the overbought condition, and now I'm starting to see sell signals on my 10-minute chart, I'm going to take some profits up here on the basis that if it comes back up above the T-line, I can always buy back in. And if I want to move a little bit faster, I'll flip to my 5-minute chart to see if the 5-minute and the 10-minute are both confirming that if the 5-minute is starting to come back below the T-line, what's that doing to my 10-minute chart? Is it taking me down? Let's see. What is a bull kicker? We'll have to find one here. I don't know whether a kicker signal. This is somewhat of a kicker signal where you had an open here and a close positive. Again, a candlestick signal is based upon the open and the close. That's the most important factors for the Japanese rice traders. And those are the final decisions each day. The The shadow is the range that it traded during the day, but the open and the close are the final decisions. So a kicker signal is when they open here and close here, creating a bullish candle. The next day, they gap it down below the open and go the opposite direction. They've basically kicked the investor sentiment in the opposite direction. I'll try to find a bullish one. But this chart was to illustrate if we've got that T-line crunch, this is what we call the bobble, where they came up, hit the 50 as a resistance level, and pulled back and started back down, but notice they couldn't get back below the T-line, and then they gap it up. What's that tell us? Well, that tells us that eventually the next target is going to be at least the 200-day moving average and possibly coming up here to fill the gap. So the question is, do we want to buy here, 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 here? And that was always, that's what everybody, this is the thing that I try to dissuade people from doing. A lot of people say, oh, that stock's up big. I'm going to wait for it to pull back so I can get into it. So you have to think of what the logic is of that. Number one, if that stock is up big and it's starting to pull back, that tells me the bulls aren't there very much anymore, number one. And number two, that's telling yourself, I'm going to wait till it pulls back to a level where my immaculate conception of where they're pulling it back to, that the minute I buy it, they're going to turn it around and go right back up again. That's kind of shooting in the dark. I'd rather be buying on a bullish signal telling me the bulls are in control. I'd rather be buying up. So I can flip to my 10-minute chart and say, all right, I can be buying right now because it's still acting strong. Does that mean it's going to pull back eventually? Could, but basically right here, if you cut off the chart, it's telling me the bulls are still there. Or if I see it right here, I can see they brought it back to the T-line. This is one of our signal patterns here. This is what we call the doji sandwich, where we have a bullish day and then a doji. And one of the simple rules of a doji, the doji is where it opens and closes at the same level during a time frame. And that's an indecisive trading, but there's a very simple rule of a doji. It's going to move in the direction of how they open it after a doji. So if I see it open positive after that, I know the probabilities are pretty strong that they're going to trade up positive, that this candle right here is usually going to be the same magnitude as this candle right here. So I can be buying here, or I can be buying here, or I can be buying here, because that's all telling me that they aren't coming back down below the T-line. So is it smart to be buying after stock is up 3, 5, 10, 15% on the day? It is, if that's the signal that's telling you they're going to go up another 40% afterwards. And so I'm convinced and have recently been learning about the Bigalow cloud. Yes, and we've had some speakers talk about it. And so I tell people, my number one criteria for buying and selling is based upon the candlestick signals. Now you can add everything else to the chart that would kind of confirm that you're heading in the right direction, whether it's the Bollinger Bands, whether it's the cloud, whether it's the moving averages, anything that you know everybody else is watching. The benefit that we have with candlestick analysis is we can see graphically what is going on at important technical levels. Or if we know that there's a retracement to a certain level, we can watch to see if there's going to be buy signals at that level and be ready to buy right at the appropriate time. So if I'm using the 10-minute chart, I can even go a little bit faster and say, all right, what's my 5-minute chart telling me? Is it time to be in these positions? So with candlestick analysis, you've got quite a few things that tell you when to be in a position, when to be out of a position, and when to be back in. And these are the patterns and the signals. First of all, again, there's our doji sandwich. Hold on for a second. So here's our doji sandwich. And notice if you put all the elements of when to be buying in place, if you have a bullish day and a doji type day, and we know the simple rule of a doji, that it's going to move in the direction of how they open it. Well, in this case, they've gapped it up and started moving it positive. We can be buying knowing that not only did they gap it up from a doji doing a doji sandwich, but they've come up through the T line. We're going to stay long until we see a candlestick sell signal and heading back toward the T line. So if we're out somewhere in here, are we afraid of moving this or missing this move? And no, because we just watched to see, notice all the dojis here, lots of indecision, and then a bullish candle. That tells us that the next wave of now this pattern, a J-hook pattern, is in progress. And we know very simply that this wave right here is going to be the same magnitude as this wave right here. So that's our J-hook pattern. We also have what we call the scoop pattern. Notice how flat this handle is, and there's your scoop that sends you out the other side. These are, again, all patterns that are recognized because you have hundreds of years of analysis or observations of what human nature does time after time. So all we're doing is analyzing what happens at the appropriate time, when to be buying. There's our bullish harami, which tells us the selling has stopped. Bullish harami is otherwise known as an inside day in Western terminology. There's our little slow curve, and notice what this trend did once it got up above the T-line. Now, I think, if I'm not mistaken, this might even be a 10-minute chart, and this is how I trade soybeans. I watch during the day to see when the soybean charts break out. So I could have bought down here, but I would have sat with it for quite a while. I could have bought here, sat with it quite a while, or I could have bought here knowing that I hit the right trade at the right time. What did the Japanese rice traders use as a T-line? They didn't. 400 years ago, all they had was, as a matter of fact, the first books I read on candlestick analysis were so antiquated that the first chapters were telling you how you built a little box, and then you put a piece of glass across the top with a light or a candle underneath it, and then you put your rice paper on top of it, and you made your little candlestick formations so you could see them through the rice paper. So their analysis was not so much using all the other techniques that we have based upon computer generation, like the T-line or the moving averages or Fibonacci numbers and that type of thing. Theirs was based upon where were you in the trend, and they didn't have stochastics because I think stochastics were created about 50 years ago. So we've got a lot of information today on the computer that we can add to candlestick analysis to tell us when to be buying or selling. In a typical day, how many scoop patterns can be found? Oh, that's hard to say. Again, a lot of people ask, what are the strongest signals and patterns? And the answer to that is none of them are any stronger than the others, other than the kicker signal, because it all depends on what the market conditions are. It might be that this week a lot of dojis are forming at the bottom and being confirmed heading up. 2 weeks from now, it might be hammer signals or bullish engulfing signals. Can you use the 3 EMA to fine-tune the T-line? Yes. Yes, again, notice on this chart that the further away we started moving from the T-line, that made us a little bit more suspicious that we might be looking at it come back to the T-line. So if we sold out here, we're right back in again, knowing that it didn't close below or couldn't go below the T-line, that we might have a J-hook pattern on whatever this was, the 5-minute chart or the 10-minute chart, telling us that there was more upside. So again, the thing that I have to go back to my basic statement, which is before candlesticks came along, I was the worst investor in the world. When I started using candlesticks, it essentially is common sense investor practices or perceptions put into a graphic depiction. So it helped me become a lot more adept at getting to the big price moves. Again, the bigger the price move, the more important the 3T comes into effect. So if I see a big breakout and I see it pulling back, again, is that a gap and crap? Well, notice they couldn't even come back to the T-line on this one. they held right up here on the 3T line. So it keeps you in positions without making you get out too early. One of the biggest problems, again, this was one of my biggest problems, was that in the old days, before candlesticks came along, I was just happier than a pig in doo-doo if I could ever even make a profit on a position. So if I bought a position and it went up, my first thought was, man, would I look stupid if this turned around and went back down and I had a loss. So I'd sell my position real quick to take the profit, and it would keep right on going. On the other hand, if I bought something and it started going down, I'd say, man, if this would go back up to where I bought it, I'd get out of it just to break even. And it'd keep going down, keep going down, keep going down to the point where it hurt so bad I couldn't stand the pain anymore, and I would sell out, and usually that was at the bottom. And my first question would be, how come when I sell, it starts going right back up again? Well, that type of trading program is what you call eating like a bird and pooping like an elephant. So everybody does it backwards because they're using their emotions to tell them what to do versus letting the chart tell you what to do. Daily using just the closing price to determine being above or below the T line. Yes, remember, the final decision is the close. So if I'm holding on to a position, even though it's trading back below the T line, if everything else is showing that we're in an uptrend, like the stochastic's heading up, other moving averages heading up, my criteria is I'll make my decision at the end of the day because it's got to close above the T line to stay in that position. What is the relation of the 3T line compared to the T line? Nothing. It just helps you. The 3T line just gives you a little bit faster reaction when your prices move well above the T line to get out maybe a little bit quicker if it comes back below the 3T line. Let me make sure I've got everybody's questions here. All right, so not only does it help you with individual stock positions, but it helps you analyze which direction the market's going to go. So it's all related. What do we want to see, or what do we see down here? We see a big morning star type signal, a doji, but notice where we are to the T line. We're a good fur piece away from the T line. What do we want to see once it gets back up to the T line? We want to see that it gets through. If we're buying down here and it fails here, we're back out of the trade because it tells us the T line is still acting as a downward resistance. If it goes through, notice what type of signal we had after the Morningstar signal. We had that doji sandwich, which was an indecisive trading day, a hammer doji type day. And the next day they opened up positive, which told us that this day right here had a good probability of being the same magnitude as this day right here, which already told us that we're probably going to close up above the T line. So it gets us in a lot faster. We don't have to wait for confirmation. I had somebody a while back say, how many days does it take for your signals? Do you wait to see that there's been a reversal in a trend? And the answer is 0. If I see a candlestick reversal signal and it confirms the next day and everything's in the right place, I'm buying immediately. We're getting in early. And if you've got the other indexes telling you the same thing at the same time where the transportation index was trading well above the T line and was backing off once you get up here, but you're still above the T line, that tells you you're still in a very simple analysis. You're in an uptrend until you see a candlestick sell signal and a close back below the T line. I don't know why the audio keeps cutting out. Ever tried candle patterns using range bars? James, no, I've never had to. Not to toot my own horn, but again, before candlesticks came along, I was the worst investor in the world. I was even a stockbroker for 8 years. So there's a whole slew of clientele from 40 some odd years ago that you have to feel sorry for. And the more I used candlesticks, more successful I became. So I'm making a very good living just trading off these charts. So anything that I try something, anytime I see or try something new, I could add it to the chart or if you want to try something new, and I tell people, if you've got a successful trading program right now, turn it into candlestick charts. It's going to make it that much more easy to see what's going on in your trading. What about the tick charts? You can do that. Use anything that has elements of fear and greed in it. How do you filter stocks to trade? Because the formulas are so simple on doing the signals, and those formulas are all over our, or they're on our website. We've got like 1,300 pages of candlestick information showing people how to use candlestick signals successfully. I run a chat room every day. We've got our main chat room, which usually has anywhere from 230 to 270 people in it each day, with people at all levels of learning how to use candlestick signals successfully, trading all methods of trading, whether it's scalping, day trading, swing trading, long-term investors, whether they're following me when I put out some commodity picks. I put out 2 or 3 stock picks every day. And I do it in a video format each night, so it's about 2 or 3 minutes. And I do it not so that people have stock picks, but so that people can be learning why that chart pattern or those signals are creating a reason for a recommendation. And so our whole process on our website is to teach people how to use the candlestick signals, how to set up their own scanning. I've got the scanning set up that even if you're a neophyte with candlesticks, in less than 20 minutes each day, you're going to be able to track down out of the 7,800 trading entities out there the best 1, 2, 3, 4 trades, how many trades you ever want to do on each day, in less than 20 minutes. I can usually pick out the best trades for the next day and somewhere in less than 10 minutes each afternoon. And I was setting this system up so I wouldn't be spending all night long analyzing which charts to go after the next day. My initial game plan was that I'd come in and trade for the first 45 minutes of the day, go out and play a round of golf, come back in for the last 30 minutes of the day to close out or open positions. And that was a perfect trading program, other than the fact that now I haven't been on a golf course for about 10 years. But once you learn how to use candlestick signals, yeah, I can show you recent trades. Now this is an older one. In the individual charts, notice how the T-line was in a downtrend until we hit the support level. We're buyers. We took profits. We're buying back in. We took profits. Now notice what's happened down on this chart. We had a left-right combo, and a left-right combo is a doji followed by a bullish engulfing signal, which is one of your strongest reversal signals. And notice the next few days they closed above the T-line, which told us as long as you're above the T-line, you're probably going to be in the next trend of this wave 3. There's wave 1, wave 2, going into wave 3. So it tells you when to get into a position, when to get out of a position. My golf game was never very good, so gave me a reason to give it up. Let's see. Yeah, I'm trying to get down to the current. And this is how I trade commodities during the day. Notice how the wedge formation. Then we had a kind of a little morning star signal. What happened the next trade? Back up above the, we're above the T line, above the 50. It tells me they were breaking this out. So right now, using candlestick analysis, we could pretty much see what our trend was in the Dow. There was that big morning star signal down here that kept us in a long uptrend until we saw a sell signal to close below the T line. There was a reversal signal right here near the 50. This is what we call the inverted hammer. The inverted hammer is one of the 12 major signals. And it was followed by bullish confirmation the next day. And where did it do it? With stochastics in the oversold area, right here at the 50. Next day, they brought it up through. And then notice what we had up here at the top. Doji, stochastics in the overbought area. It was time to start taking some profits and at least having some short positions in the portfolio. And when I say short positions in the portfolio, I've got a very simple portfolio trading technique, and it's all based upon keeping as much of my emotions out of my trading as possible. So if I've got a portfolio of X number of dollars, let's say a $500,000 portfolio, I'm going to have 10 $50,000 positions. And the reason for that is everybody always sees a chart or sees a trade, and they're going to buy the heck out of that one because that's going to make them rich. So you might have 10 $50,000 positions, but you decide, oh man, I've got a trade right now that looks great. I'm going to buy 150,000 of that one because that one's got such a good chart, it's going to go. Then what happens is if it doesn't go, you've already got your emotions involved because your superior analytical abilities said that stock was going to go up, and it doesn't. Your first thought is, well, I'm going to hold on to it a few more days, let everybody else that's not as smart as I am see that for the reason why it should go up, and it keeps going down, and you're finally selling out the position probably 3 days after you should have, just because instead of that being one unit of your portfolio, that became your favorite stock. So I keep every position equal dollar amount. So if I'm up here and I've got mostly long positions on, and I start seeing it ready to roll over, I'm closing out long positions and adding some short positions. So by the time it rolls over, I might have come out of 6 of my long positions and be in 6 short positions and maybe still have 4 long positions on. You follow what the market makers are doing? Nah. Remember, each signal is the accumulative knowledge of everybody buying and selling during a time frame. I don't care what the market makers are doing. I don't care what the experts on CNBC, such as Kramer, is saying. I want to take a look and see what the chart is telling me, because the chart is telling me what everybody's thinking, not just what one person is thinking. Yes, Jerry, I do have minimums. If I've got a relatively moderate account, let's say $100,000, and I'm buying $10,000 positions, I don't want to see a stock that's trading. My scans are stocks that are trading greater than 5 for a simple reason, and that's because most brokerage firms won't margin a stock unless it's $5 or greater. And I know that every time I put on a trade, the probabilities are greatly in my favor that I'm going to make money with it. So I want to get as much leverage as possible. So I want to be able to margin. And then I usually want to have stocks that at least have 200,000 shares traded each day, because when I make my decision to get in and out of a position, I don't want to be sitting around for 3 minutes, 5 minutes, 10, 20, 40 minutes to get out of the position. I want to get out and move on to the next position. Now, obviously, if you've got a $50 stock, it doesn't need to trade 200,000 shares a day, because you're probably not going to be going in to buy 5,000 shares, or at least I'm not going in to buy 5,000 shares of a $50 position. I might be going in to buy 800 shares. So that volume doesn't need to be quite as big. But I want to be able to get in and out of a position immediately. And so when I do the $5 or greater and 200,000 shares a day or greater, that takes that universe of 7,800 down to about 2,700. And it's pretty easy to find more trades than you'll ever be able to handle out of 2,700 share universe, 2,700 stock universe. So as we can see, there was a trend channel forming here, and we can see there was a bullish signal yesterday, and it was being confirmed. I don't know what the market's doing right now. I can probably check. The Dow's still up 260, and that pretty much tells me the uptrend is still in progress. So at this point, when I start seeing a buy signal, my next view is to see what they're going to do with the 50, but more importantly, what are they going to do with the T-line? So the day is not over. I want to make sure this closes above the T-line to tell me that the uptrend in the Dow is still in progress. And the same analysis is with the at the same time using the NASDAQ. Notice that inverted hammer, bullish confirmation, then a gap up through the T-line. Told us we were going to have some more upside. a bullish harami. Remember, a bullish harami tells us the selling has stopped. And then what did they do today? They gapped it up, telling us not only the selling has stopped, but the buying has started with great enthusiasm. And that's where we want to be, is after a buy signal showing that they're buying with great enthusiasm. And they gapped it up above the 50 and the T-line. So as long as they close this positive today, it's a high probability indication that we're still in an uptrend. What is the minimum amount of money to start trading? That's up to each individual. I mean, it should be enough where you're not getting big percentages whacked out of your commissions. But even if it's a small amount of money, you're better off learning how to invest on a small amount of money instead of jumping in with a big amount of money. You care if multiple stocks correlate with the index? No. A lot of people, let's see, how can I? For example, we've stayed in AMBA because it was bouncing up off the 50. Had a big move yesterday. I don't know what AMBA is doing today. It was backing and filling a little bit. But a lot of people say, well, what about the delta and the gamma and that sort of thing? A lot of the times, the patterns that we're buying or the signals that we're buying have nothing to do with what was going on previously. We're looking for that breakout of a slow curve or a fry pan bottom that's going to have a completely different price move or have nothing to do with the previous delta of that stock. We're looking for the next price move that's coming out of that pattern. So anyways, we've been in long in AMBA, bought down here, held on because it really didn't close below the T line, and notice what it did here, bounced off the 50 again. So we got a big price move. There was 7 points in it today or yesterday. So somebody was asking about options. Yes, we also have an option trading room where we've got about 50 or 60 people in there all the time using candlestick signals and correlating it with the appropriate option strategy for that pattern. So we're not trying to teach people newfangled option strategies. They're very simple. We're either long or short, or long the calls or short using the puts. Anytime we're within 2 to 3 weeks of expiration, we start using the spreads because they're much more effective, knowing where what our trend is and what their price target can potentially be. For example, last couple of days we bought a bearish put spread on Netflix because it gapped down below the T line. So instead of paying $6.50 for I can't remember which one it was, a 325 puts, we bought the 325 puts and sold the 320 puts for $2. So if it goes down below $2 or 320 over the next Friday before expiration, our $2 has turned into $5, which is much better leverage, much lower risk, and a much lower break even than buying puts and calls outright. Would you wait till the end of the day to buy an ETF like the diamonds? Do you believe it's still in an uptrend? Usually I'm doing probably 80% of my buying on the open of the next day, confirming the previous day's candles. Probably about 15% of the time I might be buying or selling, and usually selling, closing out a position that's not working within the last 30 minutes of the day. And then maybe 5% of the time, if there's a huge price move during the day, one way or the other, I might be trading in the day. But remember, the open and the close are your final decisions of everybody. Any trading prior to that is just noise until you get to the close. Let's see. And we also recommended AWAR because notice the fry pan bottom, notice the J-hook pattern. And this is one of the things that we teach people is how to identify the patterns. A fry pan bottom, as you can see, is a big, slow, rounding bottom pattern that you couldn't buy one way or the other or trade one way or the other. We were starting to buy in here because notice how our T-line crunch was about ready to push us up through the 50, which gave us some good move. And then it's pulled back but really couldn't close below the T line. Now, yesterday it closed, or 2 days ago, it closed right here, but there was two elements to take into consideration. One, we're coming out of a fry pan bottom, and the fry pan bottom usually creates a very strong price move. And two, a J-hook pattern could support here on the T line and start back up. And what's your prerequisite for a J-hook pattern? A very strong price move. So this is what we call the classic, which is a fry pan bottom, strong price move, and then the next wave is your J-hook pattern, which means if they've stayed up above the 50, you've got a good possibility that the 200-day moving average is your next target. Is the chat room a trading room or strictly chat? I don't understand the question. It's basically I will come into the trading room about 2 or 3 times a day, usually once late morning after the market has settled down, to go over the charts that we're following. I may come in a couple times a day if there's something happening in a specific stock position or commodity position that needs to have something taken notice of it. And then I'll usually come in for the last about 10 minutes before the market closes, and we'll do stock charts on how they finished up, usually to about 20 after 4. Again, I try not to, I try to teach people how to identify their own signals and patterns so that they're just not listening to somebody and following, because I always illustrate that if you just tell somebody what to do, they're not learning what it means, it doesn't really help them. And I illustrate that in the story of where the cop's standing on the street corner, and he sees this drunk weaving down the street in his car. He blows his whistle, pulls the drunk over, and as he's walking up to the car, he sees there's a penguin in the back seat. And he says, "What the heck are you doing with a penguin in your back seat?" And the drunk said, "Oh, I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him over to the zoo." And the drunk said, "Oh, that's a good idea. I didn't think of that." Well, the next day, the cop's standing there on the street corner, and here comes this car weaving down the street again. Blows the whistle, pulls the guy over, same drunk, walks up to the car, and sure enough, there's the penguin sitting in the back seat. I said, "I thought I told you to take the penguin to the zoo." And the drunk said, "I did, and he liked it so much today we're going to a baseball game." So if you don't understand why you're supposed to do something, it doesn't really do you any good. So these are the type of patterns. And again, the advantage of knowing the candlestick patterns and signals is, number one, the signals put you in the right position at the right time. And the patterns are the accumulative knowledge of everybody buying and selling over a longer period of time. So even if the market might be heading down, your fry pan bottoms may still be heading up because there's something else going on in that's creating that pattern other than what the market is doing. Let's see. I had another important point. So not only in an up market, if your patterns are breaking out, all boats are going to rise in a rising tide, but the patterns are going to make those boats rise a heck of a lot faster. So you're going to make a lot more money trading off the patterns because you know what the expected results are. And that's, again, 2 benefits. One, you know what the expected results are, so if it doesn't work, you're out of the position quickly. And that's part of what's created my successful trading is through the years, I've heard so many money managers say, cut your losses short and let your profits run. And in 40 years, I've never heard anybody tell you how you cut your losses short and let your profits run. Well, candlestick analysis is very simple. If there's an expected result coming out of this pattern, then there's things that it shouldn't be doing. If it does what it shouldn't be doing, you close out the position and move on to the next one. So anyways, I will take more questions, but first let me show what Pat has put on here. We've got the videos. It's about, I think, 45 minutes to an hour of training on how to use the videos. It's usually priced, I think, at $277. She's got it on here for $137. And that's the link to get to it. And I haven't read through, I think there's also, it gives you an opportunity to test our website for 30 days to see what the There it is. Okay. Thanks, Deanna. Test our website. And so a lot of people say, well, why do you give things away so cheaply? And as I was learning candlesticks, again, my rhetorical question was, why isn't everybody using candlesticks? And the answer was that there's too many of them to learn, and they didn't always work. Well, I've discovered that they do work. You just have to learn how to use them correctly. And the reason they work is because human nature doesn't change. It hasn't changed over the last 400 years when it comes to investor putting their money on the line, and it's not going to change for the next 400 years. So all we're doing is analyzing what goes on in human emotions during price moves. And there were too many to learn. As I said, I learned all 50 or 60 of them, but discovered there's only 12 that you need to learn. And once you learn them and recognize the signals, you also learn what the investor sentiment was that created those signals. And so you've got an understanding of why prices move the way they do with kind of the same background now as a seasoned investor that's been in the market for 50 years. All right, let me go back and see how do you handle long wicks during the day? Do you just ignore or still wait for a close? Depends, Robert, on how much profit I've got in a specific trade. Let's see, if I have a trade like this where I've got some big, huge profits, and that's not a good one because it doesn't have any wick. If I see something go up real big, and I think it was some of those back up earlier where they had broken out of a fry pan bottom, such as something like this, that if I know I'm already this far away from the T-line and it's up here big, that's where I flip to my 10-minute chart to say, all right, what's happening up here? If I start seeing sell signals and a close back below the T-line on the 10-minute chart, knowing that my daily chart is hugely overbought, that's where I'm going to start taking profits. The worst case scenario is it pulls back and comes back up above the T-line, I can always buy back in. But the probabilities say I want to start taking some money off the table at these levels. Oh, Shazam. Let's see. The subs in the room share and scans. Oh yeah, we've got the nice thing about our chat room is that everybody in there is learning. We've got people that have developed some very good charting techniques or scanning techniques to find the best trades. So what we've got is people come up with very good trades, and you've got the opportunity to say, all right, why is this a good trade? Or you get at least further knowledge of why that trade was coming or being recommended. There are multiple. The normal room, our normal trading room is, or the website is $97 a month, and then we've got an option trading room, which is a one-time fee annually, and it's usually the same people that are in the general trading room, but they want to go over to the option trading room where they can talk strategies on options, which ones to use with appropriate trades without having all that jargon over in the general room, kind of confusing people that are still learning how to just use the candlesticks for stock trading or whatever else they're trading. Do you recommend a book for learning the signals for beginners? Yeah. Well, obviously I recommend mine. This one right here, High Profit Candlestick Patterns, is the one with the meat in it. Tells you which patterns and which signals to go after. This is my first book, published through Wiley and Sons. It will give you more general information. So I tell people, read this book first, then read the first book second, because that will give you a little bit more filler of information of why these signals and patterns work. And then what I discovered is that even though you can, most people, even myself, in the past could identify which patterns and signals were working the best, they still couldn't make money, and it's because of the emotions. So I wrote Candlestick Profits, Eliminating Emotions, kind of emphasizing what the logic is that keeps creating these or getting into trades and out of trades, so that you're not having to fight your own emotions. And part of that is the hope theory, that you're hoping the stock's going to do something because you bought it. This book really kind of solidifies why the signals and patterns work and helps you keep your emotions out of your trades. You recommend, say, Rhonda, I don't have any live charts to look at individual stocks. Let's see. I've got to call you right back. I'm on chat. Whoops. All right, I guess with that, bull kicker. Let's see if I've got any on these charts that would illustrate the bull kicker. Just in a simple description, and this is why the formulas are so easy to put on your, this is somewhat of a bull kicker. Notice how this candle opened here and closed here, creating a dark candle. The next day they gapped at or above the previous day's open and went the opposite direction. Usually you'd like to see this as a big candle to the downside. Then they open it right here at the open and go the opposite direction. That pretty much tells you that that there's a dramatic change of investor sentiment, and so dramatic that the next move is usually going to be a very strong move for quite a while. Craig, I have absolutely no projection of what the markets are going to do, and I don't care what the markets are going to do, because I can see in the markets, is this what we're looking at? No. My positions are going to be held based upon what the market is telling me to do right now. So I'm long in these type of situations. I stay long until it's time to go short. I go short until I see the next buy signal. So because I'm not a long-term investor, I mean, I had positions that are on for 2 months here, but normally my positions are anywhere on an average of 2 to 10 trading days. So I don't care what the long-term trend is. I just want to analyze what the trend is doing right now and take advantage of that that move. And anybody that's going to try to predict what the market's going to be doing 6 months from now, I mean, if you're listening to somebody that's going to predict, what I tell people is, I don't care what each individual projects is going to happen out there. I want the market to tell me what the market is doing. And that's what the Japanese race traders say. Let the market tell you what's going on, because that's the true indicator, is what is the market telling you is going on out there. So I make money on the long side. I make money on the short side. How do you handle channeling where candles are closing above or below the T line in quick succession? That pretty much tells me I don't want to be in that trade anymore, or there's no trend to it. There are at least 78, I think up to 10,000 trading entities out there. There's going to be times when it's time to be buying Apple because it's in a trend, and then there's going to be times that you leave Apple alone because it's choppy and moving sideways. It doesn't have a direction. When that happens, you just move on to another chart. There's always going to be charts that are telling you that there's new activity coming in or going out of that stock. Let's see. 5 minutes closes, 8 EMA in a row. WW, I don't know whether that's a question. WS, my criteria for scanning stocks is very simple. I've got the different scans already set up on my chart. I'm looking for stocks that with the initial scan of being in the oversold condition where the stochastics are below 20. And then I sort them by which stocks had the biggest percent price move today or yesterday or whatever time frame. That basically tells me I've got oversold conditions with a big price move. Now I can go through those charts very quickly, and that might mean that universe of stocks is out of 2,700, maybe 140, depending on where the market conditions are at any given time. And so if I see a big price move coming out of an oversold condition, and I see that's coming up off a doji, and one of our strongest signals is what we call our best friend, which is the doji in the oversold condition, followed by a gap up the next day, that's going to produce an extremely strong price trend. So that's another thing we do in the on our website in the chat rooms is we've got all the videos on our website, but as a member, for that $97 a month, we do approximately, we've got guest speakers that come in every week. I usually do a Monday night session for members and a Thursday night session open to everybody. We go through all the charts. We go through what patterns are working, what signals are working, what sectors are working the best. And then during the week, we'll do another session, which might be the best entry and exit strategies using candlesticks, or how to scan for the best trades. These are all on video, but we do them live, so if you've got questions, you're getting that. You don't have to pay for the video. You're getting it all as part of your membership. How do we enter? It's on Omnovia. You just come to the our website, candlestickforum.com. Just hit chat room, and you could be on in a matter of a minute. Tonight, yes, we have a guest speaker tonight. What is the difference between the current special? I think the current special might be a test price where you come in for the 30-day free trial. Our website is candlestickforum.com. And then, yeah, you can find, if you go to that link that Yana just put on, you'll see all that information on how to get on and even get in for a 30-day. I think there's a 30-day free trial of it. Would it be possible to predict 6 months ahead if you were trading on a monthly chart? You could, yes. And we have just set up a longer-term picks area. They have two criteria: stocks that have longer-term chart patterns that look like you want to hold them for the next 3, 6, 12 months. And then we have another element or aspect of that long-term picks area where we can see on a chart where something has broken out and it was a big breakout. We can go back and see what caused that breakout, whether they've come up with somebody's come up with a new product or a new contract or something that's going to create something that would be a long-term situation. Do you come into the options chat room? Yes, I come in. Usually it's much quicker because there's a lot of good traders in there, but I'll come in. Today we were buying the bullish call spread on BIDA because we're within that time frame where the spreads work extremely well. You don't want to be too far out in front of the spreads because when prices move up, both your one that you sold long and short. Oops, is that my time? Okay, I'm up. Yes. Even the trial membership gets you access to all our services for a month. Thank you, Steve. All right. Oh yeah, Andrea, we bought. I forget. Can't even remember what it was right now, but we bought the call spread for January. World Cup. That's a whole different topic, and I think I've run out of time on my. Yep. So with that, thank you everybody, and thank you for having me here, Trading Pub. Hopefully, we'll see everybody in the chat rooms. Thank you.